right, why don't we get going then? Folks, I'm Sam Chandan, the Silverstein Chair and Dean of the Schack Institute of Real Estate at the NYU School of Professional Studies. Thank you for joining us for the second week of our Summer 2020 REIT Leadership Series. I'm delighted to co-chair this series with my colleague and friend, Scott Robison, a professor here at Schack and director of NYU's REIT Center. And our hosts for this series are Robin Panovka, the co-chair of the REIT M&A practice at Wachtell Lipton. Robin is also a member, a longstanding member of the Schack Institute's board. He is normally joined for these programs by Adam Emmerich, who is also co-chair of the REIT M&A practice at Wachtell Lipton. Unfortunately, Adam isn't able to join us today, but we are joined by our esteemed guest, and for any of us who have any exposure to the REIT sector, Mike Kirby, of course, needs no introduction at all. Before I pass it along to Robin to take things away, just a reminder, please do join us for this series. We really have a truly fantastic lineup. It's part of a broader range of programs that we've created at Schack this summer. There is something exciting going on pretty much every day. But this REIT series is very special for us. We kicked off with Sam Zell last week. Next week, we have Ron Havner, the chairman of Public Storage. The week after that, Hamid Moghadam, the CEO of and chairman of Prologis. They are followed by Sherry Rexroad from BlackRock, Debbie Cafaro from Ventas, Leslie Hale from RLJ. It really is an all-star lineup taking us through the end of September. So please stay tuned and come back each week. With that, I will pass it off to Robin Panovka. Robin?
Mike really needs no introduction. He co-founded Green Street, 30 odd years ago.
35. We just had our 35th anniversary.
Unbelievable. At least your beard is gray to demonstrate that. But, that's, Mike was saying earlier, that's a Corona beard, which many of us are sporting. So for those who don't know, and I think everyone does, Green Street is easily the leading research firm in the REIT space. And Mike has been a thought leader in the space, one of the key thought leaders for more than 30 years. His monthly Heard on the Beach letter or paper is just required reading for anyone interested in the space. And we're going to talk about his latest Heard on the Beach piece a little bit later. So Mike, why don't we start with some broad topics and then we'll zero in. First, you guys have been putting out weekly, I believe, a paper called REITs in the pandemic or amidst the pandemic, tracking various sectors, stock performance, enterprise value, and so on. And some of the results have been quite surprising and interesting. You want to give us an overview of what you guys have been finding?
Sure. Thanks, Robin. Thanks, Sam. Great to be here. It's, I guess we all missed the old gatherings in New York at the big conference, but this is a good substitute for it. So great to be here, and I'm looking forward to seeing some of the other panelists as well. I watched Sam last week, and I thought he was entertaining as always and informative. So it's been a tough year for REITs. We've been beaten up pretty badly. We're down, depending on which REIT index you look at, we're down 20-25% since COVID kicked in. You got the S&P flirting with the recovery of its of its losses as we speak. We're it's just barely below the line the last time I looked in terms of total returns this year. Meanwhile, REITs are lagging the S&P by call it 20%. So COVID has definitely had an outsized impact on our space. The REITs in a pandemic report was really our attempt to at least help describe what's going on. And a lot of our subsequent research has been to help explain it, but the pandemic report is really a way to capture what is going on. And what we do in there is look at unlevered changes in value. So we look at changes in enterprise value as opposed to total returns across property sectors. Total returns can be misleading you have some sectors that are highly levered, much more highly levered than others. So apartments have low leverage, malls have high leverage. You can have them move the same, or say the same amount on a total return basis, but the change to enterprise value can be much smaller for the one than the other. And so we look at it on a delevered basis. And what you see in there is, even on a delevered basis, the performance differentials across property types have been huge. There's a number of property types that have performed just great during this whole process. So cell towers, data centers they're actually up. Some sectors are barely down. So single family residential, manufactured housing, life science, some of those sectors are just skating through this without a whole lot of problems. The other end of the spectrum, you have sectors that have seen their enterprise value, so this is delevered, enterprise value down 30%. The two that fit that bill are malls and hotels. I don't think either of those are too surprising, given just kind of common sense as to where you would expect the carnage from COVID. A number of other major sectors are down somewhere in the low to mid 20s, which obviously is a pretty awful performance too. And those would be office, apartments, somewhat surprisingly, office. We have several others in that same ballpark. Strips are somewhere in there. Triple net lease REITs are somewhere in that ballpark. So it's really a disparate performance. It's really all over the board.
And is that difference basically correlated with rent collections and kind of the commonsensical notion is where people gather and the virus can spread, that's going to suffer?
Yeah, so I mean, what we've tried to do is now, we've put out a lot of research where we try to quantify what does this all do to cash flow expectations in every property sector. And there's, we really break it into kind of a short-term issue and a long-term issue, right? I mean, there's the short-term, gee, we're shut down, nobody can travel, hotels are pretty much closed, malls are closed, etc. There's going to be a day, I don't know when this is all done. And then we revert to the long term. So we really look at it as a two-part analysis where we break it into two pieces. And if you look at the short-term impacts first, so there's a huge hole in NOI that's been created by COVID. So the REIT industry as a whole, we think NOI this year is going to be 15% lower than it otherwise would have been. Not surprisingly, if you drill down to the sector level, those numbers have a lot of variance. So hotels were down almost 100%. It's just the year is a washout for hotels. Malls and strips are down a lot. If you look at NOI on a cash basis, which I think is the way to look at it these days, because there's a lot of things they're calling rent deferrals that are actually going to end up being rent forgiveness. So we're looking at more cash NOI these days, and malls are going to probably be down 40%, we're guesstimating. Strips, 25%. Student housing has been a real wild card. It's hard, the news changes every day as to who's going to open, but we think they're going to be down at least 25%. Some of those changes in NOI are like nothing we've ever seen. It's the shock to the system that's worse than has ever occurred in 35 years I've been doing this. The good news is that short-term hits don't really do that much to value. So let's just say typical piece of real estate. If I, an office building, if I take away all the cash flow for a year, but then a year later I revert back to the cash flow I would have had, what does that do to my value? Well, probably hits my value by 5 or 6%. It's the equivalent of my cap rate. I just take a year away from the value. So as big as those declines are, they're not devastating when it comes to value. In most cases, with the exception of hotels and malls, you can, even with that big cash flow hole that's going to exist this year, next year, and even the year after, the value of that hole is well less than 10%. So the immediate impacts of COVID are not anywhere near enough to explain what's happened to values. It's the long-term impacts where it really gets more interesting. And that's when we assess the long-term impacts, we're trying to say, where do we think we're going to be by 2024? And where will these property sectors stabilize versus where they would have been? And obviously, my crystal ball in 2024 is no better than anybody else's. So, take these with a grain of salt. But I will say there's been a lot of hard work put into them and a lot of thought put into them. So I think it's as good a betting line as you're going to find. And so our 2024 run rate for REIT NOI generically is about 7% lower than it would have been had COVID not occurred. So think of that as something of a permanent hole caused by COVID. It's the same concept as if you look at economists' forecasts of GDP. By 2022, 2023, they're forecasting GDP will have dropped by 2.5 points versus where it otherwise would have been, and it'll probably persist there forever. So things like this do long-term damage, and we never get back, to where we otherwise would have been. And here again, those impacts vary a lot across property sectors. We think the biggest negative long-term impact is going to be in the mall space. There's, the carnage there is going to be high. Call it a 20% decline in expectations in terms of 2024 NOI versus a pre-COVID guesstimate. Strips, we're down 15. Office and lodging, we're down, call it 10%. So, a sector like lodging should eventually get back a lot of what it's lost, but obviously you then have to ask the question, as you do with any of these sectors, has COVID changed the long-term picture beyond 2024? And with some of these sectors, there's reasons to think it has. There's a lot of issues that then go beyond 2024. But when we combine the present value of those long-term hits to the NOI run rate, plus the value of the short-term hits over the next 3 or 4 years, the numbers in most instances line up pretty well with what the stock market has already done. So order of magnitude, if the numbers I started out by saying some of these sectors are down as much as 30%, others are down in the mid-20s. What's happened to cash flow expectations largely explains most of those. So, as usual, the stock market is pretty smart.
Got it. So a lot of people think or have thought of REITs as a safe haven in a period of distress. Obviously, they haven't performed that way here. Is that just bad luck because real estate is where the virus spreads, or has the way people think about REITs changed, or is it changing? Is this a blip, or is this a permanent change?
I mean, it's tough. It's a tough question because, this has been a very, we're supposed to be a defensive sector, but we've gone through 2 straight big economic downturns, and we haven't been defensive in either one of them.
Right.
And this one, I think, based on the numbers we see, it largely makes sense. I mean, S&P tells me that based on their estimates, corporate profits will rebound back to their prior highs in 5 quarters. So 3Q21, S&P says corporate profits are back to where they used to be. Our numbers for REITs show you got to wait another year past that. So 9 quarters from now, before the big NOI hole we've dug, we dig back out of it. So, in many ways, it feels like REITs, quote, deserve to be underperforming the S&P. That's probably due to, as you said, the fact that real estate is a gathering place. Some sectors are, ground zero for what's going on. You look at the awful things going on in the hotel space. Of course, we're getting hit hard. You would think that some of this would be offset by the good news going on in some of our bigger sectors like data and cell towers. But net, it seems like it's you know, the big decline in REITs relative to the S&P, at least, I don't know if it's a little bit too big, but directionally it makes sense.
Interesting. So your recent paper, Finding Alpha in a Sea of Beta, if I understood it correctly, is essentially a roadmap of how to invest in this climate, which sectors, which companies. What's the basic thesis?
Well, it touches back to that topic we were just on, which is, you know, gee, REITs seem not to be the safe haven, and you know, REITs spent the last 6 or 7 years bouncing around with a beta of 0.5. They look like a defensive sector. So, you know, the stock market goes down 5%, REITs go down 2.5%. They, as happened though during the global financial crisis, since COVID kicked in, the average beta on REITs has been well above 1. And some sectors are up in the 1.5 range, others are like 1.2. But the vast majority of REIT sectors have become highly sensitive to moves in the stock market. So that's a beta versus the S&P 500. And since the S&P 500 these days is being driven primarily by COVID news, it's really a COVID beta. And if you're investing in REITs, you need to be extremely sensitive to that fact, that you need to acknowledge the fact that most bets at the sector level or at the company level are going to be COVID, heavily influenced by COVID news. Now, I don't know about
the stock market.
Pardon me?
As with the rest of the stock market.
Exactly. And since I really don't know anybody who has an opinion as to how this all plays out that I would trust to be right. I mean, there's some very educated opinions out there, but the smarter they tend to be, the more they admit they don't know. So I'm certainly going to admit that I don't know. And I would encourage every investor to admit that he or she doesn't know as well. It's a fool's game to play. And I would argue that people should never invest based on an opinion on how a pandemic unwinds, where the direction of interest rates. It's one of those questions that we shouldn't waste time because none of us are good at answering those. That said, volatility is great for investors, and there's a ton of volatility out there right now. And so when in sector allocation and sector picking, there's enough noise out there where if you're smart about it and you really do thoughtful analysis, you can probably spot inefficiencies as to how the market is digesting this news. I mean, if you look at that pandemic report that you mentioned earlier, when this all happened, all the sectors were sort of performing the same. And as time has gone on, the market's gotten a lot smarter, and the market is now saying, gee, you know, some of these sectors are not going to get hit so hard. Others deserve to be hit harder, and we're going to hit them even harder than we did initially.
Yeah.
That's the stock market doing what it does well. But if you, as an investor, and this is what we try to do, can get there first, you're going to make money for your clients. And there's been a lot of opportunities in this go around. And the same is true when it comes to stock picking. And it's like no coincidence that the active money managers in this space are generally having a really good year. Their total return performance by the active money managers is well above their benchmarks.
So any specific today recommendations in your mind, kind of obvious places to invest?
Well, I think I spend a lot of my time on sector picking, plus I'm not a huge fan of talking about stock picks in public forums anyway, but
just sectors.
I usually get in trouble when opening my mouth on that, but
pick to broad sectors.
Yeah, so sectors, I think there's two ways to look at it. One is where do we think the market may have overreacted or underreacted to COVID? And, you know, I look at what the market has done to, say, healthcare and apartments. And both of those sectors, unlevered basis, they're down somewhere in the low to mid 20s. Let's call it 22% in both cases. That's basically saying they're among the bigger victims of all this. I don't quite get it with either one. I mean, apartments, the news is not going to be great. Obviously, job losses like this are devastating, and there's a lot of supply coming online, and the picture over the next several years is not pretty. But at the end of the day, you know, like we talked about earlier, short-term disruptions don't do that much to the value of a real estate property.
Long-term, yeah.
And in this case, it feels like maybe investors are focused a little too much on the short-term hit and not focused on where we'll be 5 years from now with apartments. Healthcare is another space where, you know, the news coming out of that space is horrendous, and I'm sure it tugs at our hearts, you know, what's going on in nursing homes, to a lesser extent assisted living properties, but you know, it's still a problem, big problem for a lot of the assets owned by the healthcare REITs, which of course they focus primarily on senior housing. The nursing home exposure is not as big, although there are some nursing home REITs. The senior housing, look, we're going to have a lot of bad news. We're going to have some sizable drops in cash flow over the next several years. The long term, are we going to see a change in the business model? Perhaps. We're not betting on it. You know, you could make the argument that there's a fundamental long-term change in demand there for senior housing. I don't really necessarily see that. And unless there is, this is a sector that has a great demand growth profile. Mm-hmm. And sectors with great demand growth, you can absorb some bad news, because if my demand drops from 5% to 2%, supply will adjust. And I end up with a sector that still has a decent equilibrium answer. And that to me is where senior housing is long term. That you can, you know, it's got enough of a buffer there in terms of demand growth that even if things don't play out that well, it's still a pretty solid property sector. You know, the one where I'm more concerned about, and I'm sure we'll spend some time, you know, are the issues impacting office. And that would be my flip side, where it's maybe a sector where I don't quite get why the market hasn't hit it a little bit harder. And that, you know, office starts with a very anemic demand growth profile. So before COVID showed up, we were looking at, you know, very modest levels of demand growth in most markets. And so if you do anything to a sector that has an anemic starting point and you take it to a negative number, supply can't fix that. And you know, you can't cut supply and have it fix the problem the way you can with a sector with good demand growth. And so to me, I'm not so sure the market is discerning enough there when it comes to, say, healthcare, sector with great demand growth that should bail it out long-term, office, sector with anemic demand growth. If you do anything to its long-term growth profile, it's bad news.
Mm-hmm, mm-hmm. Okay, very interesting. So before we talk more about kind of broader trends, let's talk a little bit about REIT plumbing, how REITs have actually reacted to the pandemic. You know, many REITs in the harder hit sectors have cut dividends, or in some cases paid dividends with stock, drawn lines of credit, taken various measures to increase liquidity. How do you think REITs overall have performed in their reaction to COVID? Have they overreacted, underreacted, done it about right?
I think, you know, I've been generally favorably impressed by what the management teams have done. I think, you know, and maybe I'd step back and say that they set themselves up for COVID much better than they would have in the past. So kudos to the industry for getting their balance sheets right this time.
Basically, not over leveraging.
Yes, and you know, we're relearning a lesson as to why, you know, you need a good balance sheet even when you have 10 years of prosperity like we just had. It's hard to preach that lesson because it's, you know, a little more leverage seems like it's a way to boost your returns. But then you have an event like this and you realize, boy, it sure is nice to be sitting there with some firepower and the ability to survive this. So, you know, contrast this with the global financial crisis. The amount of distress in the REIT space is nil right now. And, you know, 11 years ago, we were talking about just the massive carnage caused by REITs needing to issue equity at distressed prices. So the industry definitely learned a lesson, and it's good to see it. And it's not like everybody in the industry learned a lesson. If you look at the mall space by way of example, you have one company that's not experiencing some degree of financial discomfort, and the rest of them are anywhere from very uncomfortable to in trouble. So it's not we get maybe an A- on the balance sheet grade. The mall guys maybe get a C-. Simon gets a much better grade, obviously. The rest of the actions, pulling down your credit line, chopping your dividend, I think it makes sense. I mean, when this started, we didn't know what to expect, and I'd say 4 or 5 months into it, we still don't know what to expect. And being defensively positioned right now, I think it's just what any smart businessman would do. So, and we've also seen REITs starting to take advantage of opportunities. So credit across the real estate space is in pretty good shape, but REITs are uniquely positioned with their access to unsecured debt. And last night we saw United Dominion print a 10-year, or UDR print a 10-year piece of debt at 2.1. So, I mean, unheard of rates. And as the dust starts to settle on this, we're all going to need to start questioning what's going on with the denominator when it comes to valuations. You get money that cheap in the hands of the REITs, and the topic of declining cap rates has to come up at some point. I think it's a little early to postulate that. I mean, we think real estate values are down, not up. Maybe on average something like 10%. But this money has gotten so cheap. You've got 10-year treasuries at 6, 10-year tips at minus 0.8, numbers that we've never seen. So fortunately, the REITs are very well positioned to access the cheap debt. Most of them are not particularly well positioned to take advantage of distress, but I'm not so sure there's going to be a lot of distress for them to take advantage of. But no, I think the management teams get a pretty good grade.
Okay, good. So we've touched on a few trends. Let's drill down a little bit, kind of longer term trends as to what the world will look like post-COVID. Some people are arguing that this period, the pandemic, has accelerated a bunch of trends that were already underway, and that the genie is now out of the bottle and the world will never return to where it is. For example, we've touched on working from home, telecommuting. Maybe talk a little bit about how you view your own company in terms of that.
Yeah, I mean, our experience has been, it shocked me. I mean, we left the office right around St. Paddy's Day. I haven't set foot in the office ever since. Nobody has. And this is true with our offices, and we have multiple offices, and people are not showing back up at the office. Our Newport Beach office, I'll be surprised if we open before the year is up. Especially with what's going on in California right now. We're sort of where New York was a couple months ago, as you know. But that said, it hasn't impacted our productivity one iota. I mean, if you would have asked me before this all kicked in, what would it do? I'd say, well, maybe we'll struggle through it. Maybe we'll get by, but I can't imagine we're going to be the same old Green Street. But in many senses, I think we've been more productive. In terms of the number of reports we've been able to issue, it's way up. In terms of the ability of our teams to work across teams, it's unimpacted. I'd say the level of collaboration might be higher than it's ever been because we now have more scheduled meetings, which I'm not a huge fan of that because you can overschedule meetings, but at the same time, we're forcing ourselves to interact maybe more than we used to when we just have to bump into each other in the hall. So as long as you come up with a comfortable regimen for that, I think we're all learning that, especially in knowledge-based businesses, I'm sure there's many businesses where work from home is not going to work, but knowledge-based businesses, our experience has been, it's been an epiphany that, and I'm sure we will operate differently forever because of this.
What about geographies? Some people have argued that dense cities are now dead. People can work from anywhere, so they just as soon be on the beach somewhere. Sam Zell last week was saying people will get bored of, I forget, some little town in Iowa very quickly. And after a year or two, everyone will come right back to Manhattan and the world will go back. What do you think about that?
Well, no, I'm more concerned than Sam about the gateway markets. I think work from home does a couple things. It's in the past, 85% of employees have worked in the office 5 days a week. If that number decreases to, call it 60, that's the number we've been using as a guesstimate. And this is over a 5 or 10 year period. It's not going to happen tomorrow. But if that number drops to 60%, it has a pretty dramatic potential impact on the demand for office space. And out of that newfound group of people, so the 85 minus 60, so 25% of all employees, out of that 25% of employees, you're going to have some constituency in there that still works in the office 2-3 days a week, but not every day. The number we're throwing out is 75% of that group. Those folks don't need to live right in the middle of the city anymore. They can comfortably live further out, and commuting won't be the pain 5 days a week that it used to be. I think that has to change the demand profile. And then let's just say the other 25%, and people can come up with their own guesses on this, the other 25%, they can go live someplace else. They can go to Boulder, they can go to Nashville, they can go to Austin, as long as they have the ability to show up in the office maybe once a month, twice a month, whatever the need is. Might they be willing to go commute from someplace where that really has a lifestyle they like, taxes are lower, the cost of living's lower, it's a better place to raise a family, et cetera, et cetera. I don't, I agree with Sam that most of the best and brightest are still going to want to continue to flock to New York. I think that's going to be true for a long time to come. And when I say New York, I'm really talking about a lot of gateway cities. But whereas maybe 4 out of 10 of the best and brightest in the past flocked to New York, I think going forward, we should expect that number to be a lower number, 2 or 3. And if that's true, it's a shift at the margin that's bad. And so we think work from home is going to, by itself, have a pretty meaningfully negative impact on the gateway cities, not just office, but the other property types within the gateways too. Now, I have some other accelerants. You use the word accelerant, and COVID has definitely caused 7 years to be packed into about a 12-month period here. Another accelerant has been, we've taken the fiscal crisis that many of the blue cities already have, that have been well identified, and accelerated it. It's been pushed forward. And the folks running these blue cities aren't the same crowd that ran them 10 or 15 years ago. This is a very different group of people. And it's about as progressive a group of people as you're going to run into. And some of these solutions are going to be very unfriendly to businesses. And we're already seeing that. We're seeing property tax increases being proposed. We're seeing in California, we've got one on the ballot that with Prop 13 being repealed for commercial properties, it'll happen someday. It might not happen this year, but sometime in the next 3 or 4 years, I think you should expect that to change. Income taxes are certainly going to be proposed in a number of these states. Seattle just decided to tax employees of firms with a lot, basically taxing Amazon. That's not good for demand in the gateway cities. And now you have this new issue with the social unrest. And, without touching on a very touchy political subject, I'll just make a statement that what Rudy Giuliani did, and followed through by Mike Bloomberg, but especially Giuliani did, with his policing policies, you can love them or hate them, and you can criticize them all day, and I understand the criticism, but they did allow for gentrification. And you can't look at the boom New York had and dismiss those as being, anything other than a big contributor to what happened in New York. I don't think defund is going to be a good thing for the sense of safety that we now have. Robin, you may have been there, in the same era as I was, but I certainly remember in New York where there were a lot of neighborhoods you didn't walk around, and after dark was sketchy in a lot of parts of town, and I'm not saying we're going back to that, but it doesn't take much in terms of a story or two, in terms of somebody having some violence done to themselves, a robbery, a mugging, what have you, to cause people to start thinking of living elsewhere. So I just worry about the gateways for all 3 reasons. I think they're getting hit by a triple whammy right now, and our own view has changed. I mean, we've now revised our growth rates for the gateway cities down, and at the same time moved up some of the Sun Belt cities, and we're, I'm sure we'll be getting around to the suburbs pretty soon. We haven't written that piece of research yet, but we will. It's, to me, directionally, I'm almost certain we're going to go that way. Now, I'm not smart enough to tell you how big it's going to be, but directionally, I think we have to go that way.
Well, I'm going to debate you offline on defund and some of these other points. All right. I have some kids who are very much in favor of all of that, so I'll get in trouble anyway I go here. Let's shift for a moment and talk about the shape of the recovery, and maybe it's a fool's errand to guess, as you said before, but Sam last week was guessing we're talking about a U-shaped recovery where the U starts turning up in the fall towards the end of this year. Too soon to guess, or do you have, is it U, is it V, is it W, is it swoosh, what is it?
Well, we publish a number. To make projections, we have to have a base case on the economy, but I don't feel particularly confident in it. I think it's, so our number says we don't hit a full recovery on GDP until sometime in the second half of 2022, which is pretty similar to what mainstream economists are publishing. They're maybe a quarter earlier than us, but we're not far away from consensus. In other words, it's a deep hole, and it's going to take a long time to dig out of it, and we won't dig out of it until we have a cure. So since I don't know when the cure is going to happen, then I don't know when exactly we dig out. Now, I think the question is interesting, just to harp back on a point I made earlier, which is because we don't know, investors should be very careful not to place bets on bets that are reliant on a presumed knowledge of this. So again, with betas across the REIT space so high, you can't ignore COVID risk when you bet. And so what you've got to do is balance out your portfolio. If you're overweight, let's say you love hotels right now at these distressed prices, okay, but you better go, buy some data centers or something to shelter that risk and hedge that risk. Because if hotels, if COVID flares back up or we don't find a vaccine or whatever, you're not going to win on a hotel bet.
Okay, great. I see audience questions are piling up. So one last question, and then Sam will phrase some of the audience questions. Let's talk about the makeup of the REIT market after COVID. We've talked about a lot of trends, and I would note that I think 4 out of the 10 biggest REITs today are what I would call tech-driven REITs, data centers, towers, warehouses, and that's almost out of nothing tech-driven about a decade ago. Take us forward 5 years, 10 years. What does the REIT market start looking like with all these trends playing out?
Yeah, I mean, it's been fun to watch. It's been such a dramatic change. Sometimes you don't realize how much things have changed until you step back and look at them. But 20 years ago, 80% of the REIT market was core property sectors. So by core, I mean retail, industrial, apartment, and office. As recently as 5 years ago, core was half of the REIT market. And now core is down to 35% of the REIT market. We've seen 3 sectors hugely increase their market share from low teens up to 30% combined, and those 3 are data, cell, and healthcare. We've seen 2 sectors go the opposite direction from mid-30s down to the teens, and that's office and retail. So, what does that tell me? You step back. Where is the economy going? Where has the economy gone? Well, data, cell, tech, healthcare, those are where the economy is headed. The very nature of real estate changes as the economy changes. Office, retail, we've had way too much space for my entire career, and now we're finally correcting for it. Those are not high growth areas. So I don't know what's going to cause these trends to change. I think 5 years from now, if we have this chat, we're going to say, boy, can you believe how much more of the space is now owned by these, quote, niche property sectors, and how insignificant some of the longtime core property sectors have become. And, it's everything I said is what I think, but more importantly, it's what the market thinks. I mean, the market, as it prices these companies, it now ascribes hefty premiums across a lot of these sectors. I mean, it probably comes as news to a lot of folks on this call that the average REIT's actually trading at a premium to NAV. And that's because these core sectors trade quite well. The average REIT in a core sector is trading at a big discount. And I think that's what a lot of people focus their time and energy on. But the real action is away from the cores. The core sectors trade at big discounts. You really have to ask yourself, from an evolutionary standpoint, are some of these concepts that have been long prevalent in the REIT space becoming dinosaurs? I mean, if you're on the board of a New York office REIT, you're looking at your stock price and you're saying, gee, we've been trading at a massive discount to NAV for at least 5 years, probably more. The public market either doesn't get it or the private market doesn't get it. Somebody doesn't get it. But why are we public? What's the point of our existence as a public company? Those conversations will happen. I'm not predicting, immediate M&A with any of the, it gets down to an idiosyncratic thing at the company level, and I'm not predicting that any of the New York office REITs are going to do that very soon. But if you just step back and look at it, some of what's out there now as public REITs, I think will go away from the scene, and we'll have a bunch of new ones come up in growing sectors.
I before I hand it over to Sam, I was going to stay away from NAV because you and I have debated it enough times over the years. But you just used the term. I mean, is it really relevant at the moment, given the absence of any price discovery? Does anybody know what something is worth in the private market right now, since nothing's sold for the last 5 months?
Yeah, I think it's a good question. I think in some instances we have some insight, and in others it's a guess. We have transactions now in industrial, certainly, apartments, there's some clarity. Office, we've seen some retrades that give some indication of where things might land. I think that, digging deeper into your question, do I know what a portfolio of New York office buildings would sell for as opposed to an individual New York office building? No, I don't. And so, it makes that board discussion trickier. Could these companies actually find a bid for billions of dollars of New York office? I don't know the answer to that question. My guess is it would be tough to find a bidder at this moment in time. But I'm talking long term. I mean, this is not like it's a new phenomenon. And 8 months ago, we did have some clarity on NAVs across the board, and everything I just said about some of these discounts was still true back then.
Fair enough. Sam, audience questions?
Yeah, no, there's a whole bunch. I want to start with one about the office sector, Mike. When I talk to a lot of the office landlords, the view seems to be fairly extreme. I'm talking about what's the role of remote working in your company's equation going forward, and a lot of folks come back and they seem to feel very strongly that the office sector is going to come out on the other side of this, and it's going to be fine, and there's no substitute for getting together. And they're really discounting the possibility that remote work will play at least some role in the way that we move forward. Are they just in denial?
Yeah, I mean, I guess that's the first stage of grief, right? Is denial. I really, it's been surprising to me to hear the New York, or not just the New York REITs, but all the REIT office execs sort of sing pretty much out of that same songbook. I just don't know how that happens. I mean, I get culture. I mean, we've built a firm for 35 years that now has over 200 employees and has international offices. We need to go into the office. We need to train young people. We need to find a way to make all that work. Does it have to be the way we've always done it, where everybody in the office shows up 5 days a week? No way. I mean, we've learned a lot during this downturn, and I know that's not how we're going to be running our company. I think we're uniquely qualified to do a work from home business model. And when we do our projections and we come out with a fairly bearish view on office demand, we still assume most people spend every day of the week in the office. So you don't need to make draconian assumptions here. You don't need to say anything absurd like, gee, nobody's ever going to come into the office again. Nobody's saying that. We're certainly not saying that. We're saying that 60% of all employees versus 85% are still going to spend 5 days a week in the office. That doesn't sound to me like a real bear case.
To your point about having a reserved outlook on the gateway cities. So is your overall premise, is it fair for us to say that the value of place, or the primacy of high agglomeration cities, is diminished somewhat by all of this? And so the trade-off becomes really, really tough. I mean, one of the things we're looking at closely that you also mentioned is the real fiscal challenges that we face in New York, Chicago, other major metropolitan areas. That balance of value versus cost to locate in a major CBD looks like a tougher proposition going forward.
Yeah, I mean, look, Gateway has been the place to be, right? I mean, during this millennium, starting about 2000, let's say, if you would have put your chips, as the REIT sector did, on gateway markets, you looked really smart for doing that. And it's been a great place to have placed your chips. It started to change 5 years ago, though, in the public market. I mean, public market has been leery of gateway markets for quite some time, and that's true in the apartment space, it's true in the office space. Gateway has already started, before COVID, has already started to lose quite a bit of luster. And if you look at the gateway office REITs, they've been underperformers for 5 years. You look at the gateway apartment REITs, the MAA which is non-gateway, has been the best performer over the last 5 years. It's the public market's been on this for quite some time, and then you drill down more into the data and you see that as of 7 or 8 years ago, there was a big move towards gateway markets by people with money. That's slowing even before COVID. That the trends for gentrification had already started to slow. Well, what does SALT do? So, we changed the tax law 2 or 3 years ago, and you can no longer deduct your state and local income taxes. We're only now starting to see people react to that. It takes people some time to react. That was a huge tax increase for people of means.
For me and Robin, but I think to your point, we'd get folks who would come back 6 months later and say, no one's left. But to your point about the office sector, these are not trends that then are going to play out. We're not going to see a mass exodus 2 months later.
Right.
This is about behaviors on the margin that will take time to show up in the relative demand profile. Yeah,
probably a decade or longer. I mean, it shows up by people not moving to a place. That's probably the biggest impact. And for that to build up, it takes a long time.
Yeah. So we've got a few more minutes left. Let's talk briefly about the other dimension of geography. We've talked about gateway versus secondary cities. And I know the report hasn't come out yet, but give us a preview on your thinking of folks locating in the CBD versus relatively more suburban areas. Again, a lot of this conversation for folks ends up at the extremes. We're not talking about folks moving to Levittown. We're talking about folks maybe not living in the absolute center of the city. It's not going to happen overnight, especially over the last couple of months. Physical mobility for households has been constrained. When we asked Sam Zell last week, he said, well, if someone moves to the suburbs, tell them to send me a postcard. But so he's clearly not going. What are your thoughts?
Well, quick little anecdote that, here we are in Newport Beach, which is a classic suburb of a big market. We had a job posting for an associate position on our research team, and the number of applicants that came in was like 7 times higher than we've ever had for one of these postings. Now that's a big COVID effect, right? I mean, it's people probably from LA, even from New York though, where they're thinking, gee, this is going to be 2 years. I really need to get out, and a place like Newport sounds pretty good all of a sudden. That's more of a short-term anecdote. I don't necessarily expect that to persist, but I do think nice suburban markets, and there are quite a few of them, there's usually 3 or 4 outposts that have gotten quite nice around any of these gateway markets that are fine places to live, and they usually have a town center. They usually have a place where you can walk around, go to a number of different restaurants. They have kind of a high street feel to them. Are they Manhattan? No. And if you need Manhattan, then there's going to be a certain constituency that always loves Manhattan. I fully get it. I love Manhattan. You're going to have people there, but at the margin, these suburban places are going to become more attractive. And I think for the younger folks on the call, it's easy to forget that gateway hasn't always won. I mean, when the modern REIT era started, I remember writing reports on gateway REITs as they started to come public. So this would be Carr and Beacon. So Carr was DC, Beacon was Boston. And their biggest problem was they had cash flow growth for the next few years after coming public in 93, 94, that was 0. That's because gateways were struggling. I remember we put out a report on Highwoods at the time. Highwoods was Sunbelt markets, and their cash flow growth prospects were excellent. It's, we go through cycles where Sunbelt beats gateway, And for the folks that have been watching as observers for the last 25 years, you just think Gateway always beats Sunbelt, but that's not true.
You know,
Yeah.
I must say, and I'll betray my own bias, I wonder how much of your worldview creeps into the view you formed. I mean, you're someone who chose to start a business in Newport Beach rather than Manhattan. So 35 years ago, you made your decision. I and probably Sam have probably the opposite bias. My own view is I love Manhattan. I think just as after 9/11, people just forgot. For 2 years, said no one will ever go in a high-rise building and so on.
Right.
4 years later, everyone forgot about what happened on 9/11. I'm making the opposite bet. When we have a vaccine, the kids are just going to rush back. Could be wrong, but
You know, we wouldn't have interesting markets if people agreed on everything. And I think your view is highly plausible. You know, I'll just say
NYU program, so I feel compelled to.
Yeah, no, of course, we're both big believers in New York, but I should say, Mike and Robin, you both described sort of a time where there was real variation in the neighborhoods and the environment in New York. A lot of folks are also not going to remember what it was like to have a fiscal crisis in New York or Philadelphia, and the impact that can have on the viability and competitiveness of a city in bringing both jobs and people in and maintaining a favorable trade-off of services and taxes. And I think, as big a believer as I am in New York, we're going to have to manage a lot of these issues, congestion in the subway system and in our infrastructure. There are ways in which we manage this well and ways in which we don't. And a lot's going to depend on the choices, on the kind of funding we get from the federal government. It's not a sure bet if we drop the ball on some of these things. Mike, one last closing question for you. Our audience favorite question is really going to test the limits of our collective crystal ball. But in the same way that we've had data centers and others sort of come into the fray and into the mix over the last couple of years, they're asking 5 or 10 years out, what is that next sector that becomes a significant feature of the REIT mix?
it's always hard to say. I mean, we had kind of a flurry of new sectors come in 5-6 years ago. We had some IPOs, we had some REIT spinoffs. We haven't had a lot of that lately. So there's not a lot of nascent, sectors out there incubating. One that's come along and done very well, maybe even surprisingly well, is gaming. That is a sector that, look, we didn't know what to expect when we first bumped into the gaming REITs maybe 5 years ago. But it's a sector that makes a lot of sense. Now it's a sector where they already own a lot of the gaming facilities in the country, so they can't expand that hugely. But it's always hard to see. I mean, it's hard to see this coming. Right now, we don't have a whole lot of sectors out there incubating, but I think, it's possible. There's still talk that someday we may see some of these transport, like the pipeline infrastructures of this country. There's talk that could easily become REITs. A lot of it's owned in master limited partnerships these days. I don't know if that's going to happen or not, but it's presumably a pretty big business. Others, like cell towers, are just going to continue to grow. And so I think some of the ones that, the ones that are going to take up most of the market share are going to be the ones that are already there. I don't really have a great answer as to who that new hidden gem is. It's only because we haven't been incubating any.
Yeah, well, to your point earlier, the smart people are ready to admit what we don't know.
Right.
So, Robin, take us out.
Well, Mike, that was really fascinating. Thank you very much. Really appreciate. Next week, we have Ron Havner, and the week after that, Hamid Moghadam. But thanks again, Mike. Really appreciate it. Take care, all.
Thank you.
Thanks, Mike. Thanks, everyone, for joining us.